Hi, everyone, and welcome to the Executive Espresso Break, the caffeinated edge for scaling success. I'm Sam Palazzolo, and I want to welcome you to this special episode where we'll be diving into the critical finance and capital strategies that CEOs need to scale their businesses effectively. We're going to cover how to make smarter capital allocation decisions, master cash flow, and even discuss when M&A might be the right move for your growth journey. So, whether you're running a startup, an SMB, or a Fortune 500 organization, this conversation is packed with insights that you won't want to miss. So, let's get into it. This is our agenda today. Again, we titled this The CFO Strategies for Scaling Success, and we're going to cover four broad areas. The first, CFO perspective on scaling. Second, capital allocation and ROI driven growth. Third will be cash flow mastery and working capital optimization. And then we'll bring it home with that fourth section, M&A as a scaling strategy. I'm joined by Mr. Matteo Turi. I'll allow him to take some time, introduce himself, and then I'll introduce me because you're probably wondering, who are these people and how can they possibly help us? So, Matteo, take it away. Introduce yourself.
Okay, so first of all, thank you so much for having me today. I have been a CFO for the last 17 years, primarily in a number of industries, but mostly lately in infrastructure, like renewable energy, clean technologies, also water sector. It's been in a number of situations, ranging from startup to scale up to eventually exit situation, but also crisis management. And today I'm very pleased to be able to tell you about my experiences. In fact, there are so many situations they can experience in business, and there's never going to be a book that's going to tell you what to do because it's all about the situation in which you're in. So yeah, it's a pleasure for me to join you, and back to you, Sam.
Yeah, no, I love it. Real strategies, real solutions, and results. That's my tagline. Again, I'm Sam Palazzolo. I'm a managing director for an investment bank where I specialize in M&A, but I'm ex-Deloitte, and I run a business scaling consultation and coaching practice where I help leaders take their businesses. I've taken them from $10 million to $1 billion and beyond. So my pleasure to be with you, and thank you, Matteo, for joining me today. I do want to make this offer to you. It's our 2025 Executive Espresso Strategy Session. I offer these, think of it as an executive briefing. In 20 minutes, you and I will connect, audience member, and identify your most pressing opportunity, discover the true cost associated with those opportunities, and we'll drive from what the opportunity is all the way through action plan in 20 minutes. I'll also share our 2025 scaling programs, and I'll tell you a little bit more about that a little bit later on. But Matteo, let's get into it. I encourage everybody, grab your cup of espresso and hold on tight because our first item that we're going to talk about today is the CFO perspective on scaling. Matteo, let's start with the big picture. Scaling a business isn't just about driving growth, it's about ensuring that the financial foundation can support growth. I wanted to find out from your perspective, and it's our first question here, what are the most common financial blind spots that hold companies back?
Yes, I will start with the perspective usually, business wide. Yeah, generally speaking, when you scale a business, it's an exciting moment because the market has accepted your product. So it's really time to execute. So unfortunately, this is where we see lots and lots of business failures. So the question is very pertinent to a number of situations I've experienced in the past. So to really make it simple, a business should be doing three things very well. Number one, sell, obviously. Number two, produce. But number three, the most important is to generate cash flow. Generate cash flow is the ultimate goal. As a talking point, in this situation, the CFO should really advocate for dynamic financial models because you have to adapt to a scaling reality, which is not really written on a book, as I said. It's a reality that is learned day by day. And it needs to really encourage investment in systems that provide real-time insights. You don't want to be late to the game, in a few words, yeah?
Yep.
So what are the yeah, I don't know if it happens to many of the people who are watching us here, but you just want to be really, you want to anticipate the question. You don't want to wait for the question to be asked, really. So financial blind spot, you tend to have cash flow mismanagement. Now, generally speaking, companies underestimate how scaling can increase expenses like hiring, production, marketing before revenues catch up. And I've been in that situation so many times where I really was putting a brake on recruitment, putting a brake on marketing expenses before the business was going to realize its full commercial really potential. And sometimes I was sitting in the board of directors and telling them, we're not spending as much as we budgeted. Why? Because it's discipline. First, we want to make sure the commercial activity is going really well. The other problem is underestimating operation costs. Now, usually business overlook rising costs from logistic, infrastructure, system upgrades needed to handle growth. Yeah, because again, each situation is unique. And this is why, again, discipline is really paramount. Scenario planning. Normally, we require to be flexible on this, but we need to have at least 3 scenarios. We need to have a best case and worst case. Even if you're a startup or an early stage business, you need to do those stress tests. You need to ensure that the business can really survive any situation where, for example, you might lose one particular customer that you rely too much on. Misaligned metrics. Sometimes companies rely too heavily on revenue growth. They just bet on growth, and the bet is too dangerous sometimes. So ignore profitability or efficiency ratio. Example, a SaaS startup rapidly scale its user base, but failed to foresee rising server costs, which erode margin. Last but not least, the big mistake I see a lot of times is the customer acquisition cost versus the lifetime value of the customer. If the customer acquisition cost is higher than the margin you're making on a customer on a lifetime value, you're instantly losing money. You're instantly betting for failure, effectively. Hope that gives you a bit of an idea. Obviously, there are so many cases, but I just gave you some ideas, okay?
No, it's great, great insight, great overview. It takes us nicely into the second question here when it comes from the CFO perspective on scaling. How do those differ between early stage growth companies versus mature enterprises?
Yes, this is where effectively a good CFO needs to be really good for any season. It could be spring, summer, winter. You need to understand where you are, what business stage you're in, because maturity stage is not the same as a rapidly scaling business. So the CFO roles can shift from a survival mindset in startups to an optimization mindset in mature businesses. So you require really a tailored strategy for each phase. Yeah. Now,
Mhm.
some of the blind spot I told you before, you also find them in this situation. But what's one of the most recurring issue with early stage companies? But basically, the challenge is differently. Basically, the challenges are you have to focus on achieving product market fit. Because you're new to the market, you really have to start gaining market share. So it's important to do that. And most of the time, businesses, they really underestimate the importance of financial intelligence to a business. Now, pricing strategy is not just a commercial decision. It's also a financial intelligence decision. As I said before, if it costs you too much to acquire a customer, then you should not go out with a customer unless you're going to have, it's going to give you some other opportunities to develop other revenue stream. Now, the other big issue is not chasing more than one revenue stream. So sometimes you'll find businesses chasing one revenue stream, one customer. That's a risk. And discipline on risk management is where the CFO should always be absolutely on top. Now, this is where even if the CEO, even if the shareholders are not particularly disciplined, the CFO is absolutely responsible. So what I would say is if it's not written in your job title, it doesn't matter. It's your job. You have to anticipate this issue. So that's the way I would really establish any kind of CFO sort of position to be filled. Now, mature enterprises, it's a different world, yeah. The challenges are about resource optimization, cost control, managing legacy system. What you find normally in a mature business, the risk is obviously relaxation. For example, thinking that a customer that has been your customer for the last 10 years
Mhm.
will continue to buy from you. So one of the biggest issue is really it is potentially lack of innovation. So you need to keep innovating. You need to keep really ensuring that your customer is happy with your product, and you need to do all you can to extend the lifetime value of your customer. An example is sometimes you may find that businesses they are better selling to existing customer than acquiring new customer. Now, if that's your strength, then you invest in that strength. Don't invest in new customer or not as much as you would by extracting more revenue from the customer. Obviously, each situation is different, but I just wanted to give you a flavor.
No, it's great perspective. Traditionally, we think of the job of customer success or customer retention to be that of the sales department and or marketing, right? To go make certain that we're getting the right customers with us in alignment so that way they stay with us. But the vantage that you just shared from the kind of CFO perspective, the accuracy with which you're extending capital, cash flow guidelines, mitigating risk, all of those things hinge on customers, which typically goes back to the nothing happens till you sell something, but it's a wonderful role for the CFO to take in perspective to help with accuracy attempt to identify how long customers are staying with us and why would they stay with us from an innovation perspective. So unique perspective and key distinctions also between not only those blind spots as well as how those things differ between where an organization's at along its life cycle, right? Early stage versus mature. So very interesting.